Investing money can be a great way to achieve your financial goals and build wealth over time. However, it can also be intimidating and confusing, especially for those who are new to the world of investing. Making mistakes is a natural part of the learning process, but some mistakes can be costly and set you back in your financial journey. This is why it's important to learn from the mistakes of others and avoid making them yourself. To help you on your investment journey, we've compiled a list of 10 common investment mistakes to avoid. From failing to diversify your portfolio to letting emotions guide your investment decisions, we'll cover all the pitfalls to steer clear of. Read on to learn how to avoid these common mistakes and make smart investment decisions for your financial future. 1. Investing without a plan. Investing without a plan is one of the most common investment mistakes made by people. Many people believe that investing is all about buying stocks, bonds, or mutual funds and hoping to make a profit. However, investing without a plan is like driving without a destination in mind. You may still get somewhere, but it may not be where you intended to go. Before you start investing, it's essential to have a clear financial plan. This plan should outline your financial goals, time horizon, risk tolerance, and investment strategy. Your investment strategy should be based on your financial goals, which can include buying a home, paying off debt, saving for retirement, or building wealth. Your investment plan should also include an asset allocation strategy. Asset allocation is the process of dividing your investment portfolio between different types of investments, such as stocks, bonds, real estate, and commodities. The goal of asset allocation is to create a balanced portfolio that matches your financial goals and risk tolerance. Having a clear financial plan and investment strategy will help you avoid making rash investment decisions based on market volatility or other external factors. It will also help you stay focused on your long-term financial goals, and ensure that you are making informed investment decisions that align with your financial objectives. So, before you start investing, take the time to create a financial plan and investment strategy that is tailored to your needs and goals. 2. Following the herd. One of the most common investment mistakes is following the herd. It's easy to get caught up in the hype of a hot stock or investment opportunity when everyone else is talking about it. However, this can be a dangerous trap to fall into. Just because everyone else is investing in a particular stock or asset class doesn't mean that it's the right investment for you. It's important to do your own research and fully understand the risks and potential returns of any investment before putting your money into it. Investing based solely on what others are doing can lead to poor decision-making and can cause you to miss out on other potentially profitable opportunities. It's important to remember that investing is a personal journey and what works for others may not work for you. Instead of following the herd, take the time to assess your own risk tolerance, investment goals, and financial situation. This will help you make well-informed decisions that are in line with your own financial goals and objectives. Always remember that investing should be about making smart decisions that will help you achieve your personal financial goals, not about following what everyone else is doing. 3. Focusing too much on past performance. One of the most common investment mistakes is focusing too much on past performance. While past performance can give some indication of how an investment has performed in the past, it should not be the sole determining factor when deciding where to invest your money. Investors who focus too much on past performance may fall into the trap of chasing returns. This means that they invest in an asset or fund that has performed well in the past, hoping that it will continue to perform well in the future. Unfortunately, this is not always the case. Markets are unpredictable, and past performance does not guarantee future results. It's important to take a more well-rounded approach to investing by considering other factors such as the current market conditions, the asset's fundamentals, and your own risk tolerance. Another issue with focusing too much on past performance is that it can lead to a lack of diversification in your portfolio. Investing only in assets or funds that have performed well in the past can lead to a portfolio that is heavily weighted in one particular sector or asset class. This can increase your risk and leave you vulnerable to market fluctuations. Instead, focus on creating a well-diversified portfolio that is aligned with your financial goals and risk tolerance. By spreading your investments across multiple asset classes, you can reduce your overall risk and increase your chances of achieving your long-term financial goals. 4. Lack of diversification. One of the most common investment mistakes is a lack of diversification. Diversification is important because it helps reduce the risk of losing money in a particular investment. It involves spreading your money across different types of investments, such as stocks, bonds, and real estate, as well as different sectors, such as healthcare, technology, and energy. By diversifying your investments, you can reduce your overall risk and improve your portfolio's long-term performance. Many investors make the mistake of putting all their money in one investment, such as a single stock, or a single sector, such as technology. While this may seem like a good idea if the investment performs well, if it doesn't, you could end up losing a lot of money. By diversifying your investments, you can spread out your risk and reduce the impact of any one investment's poor performance. Another mistake that investors make is not rebalancing their portfolio regularly. Over time, your portfolio's asset allocation can shift, and you may find yourself overexposed to one type of investment. By rebalancing your portfolio regularly, you can ensure that your asset allocation remains in line with your investment goals and risk tolerance. In summary, diversification is a key component of any successful investment strategy. By spreading out your investments across different types of assets and sectors, you can reduce your overall risk and improve your portfolio's long-term performance. Don't make the mistake of putting all your eggs in one basket. Diversify your investments today. 5. Timing the market. Timing the market is a classic mistake that many investors make. Trying to predict the future of the market and buying or selling stocks based on that is a risky game. Even the most experienced investors can't predict the market's next move with absolute certainty. This is why it's best to avoid timing the market altogether and focus on a long-term investment strategy. Investing for the long term means holding onto your investments for a significant amount of time, usually years or even decades. This approach helps you ride out any short-term dips in the market and recover from any losses. Over the long term, the stock market has always trended upwards, and patient investors who stick to their long-term strategy usually reap the rewards. Another mistake related to timing the market is panic selling. When the market takes a sharp dive, many people panic and sell their investments, with the expectation of buying back in at a lower price. However, this is a dangerous game, as the market can quickly rebound, and you may end up missing out on significant gains. Instead, investors should stick to their long-term investment plan and avoid making rash decisions based on short-term market movements. In conclusion, timing the market is a common mistake that can lead to significant losses. Instead, focus on a long-term investment strategy and avoid making emotional decisions based on short-term market movements. By avoiding this common mistake, you'll be on your way to achieving your financial goals. 6. Chasing hot stocks or sectors. One common mistake that many investors make is chasing hot stocks or sectors. It can be tempting to invest in the latest hype or trend, but this strategy often leads to disappointment and losses. The problem with chasing hot stocks or sectors is that they are often overvalued and have already seen significant price increases. By the time you invest, you may be buying at the top of the market, and the stock or sector may begin to decline in value. Instead of chasing hot stocks, it's important to focus on building a diversified portfolio that can weather market fluctuations. This means investing in a mix of stocks, bonds, and other assets that align with your investment goals and risk tolerance. You should also avoid making emotional investment decisions based on short-term market trends or news headlines. Instead, focus on the long-term outlook for your investments and stick to a disciplined investment strategy. By avoiding the temptation to chase hot stocks or sectors, you can build a solid investment portfolio that can help you achieve your financial goals over time.